Good evening. A warm welcome to all the members, all the investors who have joined today's session. I know this is a very exciting session because today we have our Chief Economist, Mr. Tirthankar Patnaik, with us. Tirthankar, firstly, thanks for taking time out.
Thank you.
I know it's an extremely busy schedule for you, and appreciate. Especially today, given the the hectic meetings that you had today. Tirthankar, as a background, Tirthankar is the Chief Economist of NSE since the last 4 years. He has over 2 decades of experience in Indian capital markets, academic research, macro and sector strategy, consumer banking, and quantitative finance. Tirthankar, we have received certain questions from various investors, various members as well, and certain retail participations. Before we get into those questions, I thought, do you just want to share some thoughts on overall macro?
Yeah, certainly, Abhishek. First, thanks a lot. Thank you. It's always a pleasure being here. The Indian story today is that of a $3.8 trillion market with a 3.2, $3.3 trillion economy in GDP terms. This year, about 300 lakh crores, according to our budget numbers. So 300 lakh crores, 1.4 billion people. And it is also the world's fastest growing economy. So fastest growing large economy. 6.3%, 6.4% is what has been looked at for this particular year. And if I look at the Indian economy over the last 3 years, in terms of the recovery from the pandemic, India stands out in a meaningful manner.
Yeah.
So while world across, global economies have seen runaway inflation, strong recession, India has seen neither. It's not as if India did not see high, inflation, but inflation in India is far more under control versus other economies. The Indian economy is not as indebted as others, and this is kind of reflecting in markets as well. So I believe that India at this point is a fairly strong.
Absolutely, yeah. It continues to remain in the sweet spot
Yes.
as compared to other geographies. We'll just quickly delve into the questions that we have received so far.
Please.
The first question actually is from the FPI, the foreign portfolio investor. What they would like to understand is if you can throw some color on FI or FPI inflows into the Indian equities in the light of tightening global financial conditions and the geopolitical tensions.
So the Indian market, as I said, is about $3.8 trillion, and FIIs today constitute just shy of a fifth of it. So about 19+% of the overall market is with foreign portfolio investors. That gives you a portfolio north of $750 billion. This is the FII portfolio. And the annual inflows, outflows of capital on a net basis in the equity channel is around 5 to 7 billion, $10 billion or so. It has risen significantly in some years, and it has been lukewarm in others. And if we could show you a slide here,
Sure,
which explains the trend of this flow, then things will become much more clear. Yeah. So I have here for you FII flows over the last 20+ years. And what you immediately notice is that FII flows have become huge in some years and have become lukewarm in others. But something stands out. Only 3 times in the last 20+ years, over 2 decades, have FIIs have been net sellers of India. And what were these years? 2009, that was the global financial crisis. And then you had something strange. FY20 was the pandemic year, and no, FIIs were barely negative sellers, very low. But FY22 was the year in which FIIs sold the most. What actually happened? So this year, Abhishek, was one where central banks all over the world raised interest rates in a meaningful manner, which led to an exodus of capital from all risk assets, commodities, emerging markets, and what have you.
right.
And India was no different.
No exception,
So,
yeah.
no exception at all. And FIIs therefore were big sellers during that time, and they remained so in the following year as well. However, if you look at this year, FIIs have put in about $15 billion already. So if we could show you this in slightly more detail, then notice this particular slide where we've tried to provide not annual figures, but quarterly figures. And the columns here show that, the recent quarter is where FIIs have become a little, reticent about India again. So, I mean, this is in line with what's happening with global markets,
Right.
because there is an expectation that the high interest rates are likely to stay for a while, according to Fed commentary, and that is what is reflecting. I also wanted to show you something else here. I had mentioned that FPIs own about 20% of the Indian markets.
Right.
But what we're also trying to show you here is FII ownership as a percentage of the floating stock, the free float in the markets. And that number is about, slightly north of 35% at the moment. So FIIs own about 35% of the free float in the markets today. And, this figure used to be higher earlier, but at this point, it is on a gradual decline. It is FII ceding space to sort of domestic investors.
Sure. So thanks, Tirthankar. With that, actually, the next question is on the domestic institutional participation.
Certainly.
Again, members are looking forward to hear your thoughts around how the domestic institutional participation has been over the last few years, and how much do they currently own in Indian equities?
So, Abhishek, the mutual fund pie today is about 46 lakh crores. And mutual funds, that includes debt and equity mutual funds. If you look at equity mutual funds, it will be slightly north of around 20 odd lakh crores. If I look at a percentage of the Indian market, so out of the 320 lakh crores of overall market cap in the country, mutual funds, according to latest quarterly data, have about 8.5% or so. And this is equity mutual funds, of course. And then if I look at another category, banks and financial institutions, which actually includes insurance companies having an equity, like LIC, as an example, that number would be slightly north of 5.5%. So if I add these numbers up, you get to about 14.5%, 15% of the Indian market that is owned by DIIs. Right. And again, if you could have a slide which could show this in greater detail. So, yes. So what we see here is that DII flows have been all over the place. So they have been positive in certain years. For instance, at the beginning of this particular slide here, we are at the global financial crisis, FY08.
Okay.
This was the year where for 2 years, mutual funds put in a significant amount of money. As you can imagine, FIIs were big sellers. Right. They were selling to DIIs, and therefore DIIs were big buyers at that point. But after that, DIIs have been, tepid. But things started changing around FY17, FY18. So, 30,000 crores or thereabouts in FY17 rose to over a lakh crores for the first time in FY18. Yeah. And then it followed up by another year with a lakh of crores, 1.2 lakh crores in FY20. FY21 was 1 year, pandemic period where DIIs sold. But after that, things have been major. So 2 lakh crores for the first time in FY22, and 2.5 lakh crores that we've seen last year has been the highest sort of ever. Highest ever. And if you could show you a similar slide, which shows you slightly closer data. And here what we have for you is the SIP inflows. This is money that is going on a regular basis to Indian markets. And this is something that has not happened earlier. Right. As you can see this trend. So on the left hand side is your monthly SIP inflow. And in June, it used to be just about, and this is quarterly. I'm sorry, this is about quarterly. So over a quarterly basis, the number used to be 10,000 crores. Right. That's about it in June 16. Today, on a quarterly basis, that number is 45,000 crores. Right. So this is the incremental money that's coming into the Indian markets, and it has been especially strong over the last 3 years. And obviously, this has also led to a rise in the share of domestic mutual funds. So right. You asked me about how much do they own. Correct. So that 8.5% today comes here. And as we showed you for FIIs, if I look at free float owned by domestic institutions or domestic mutual funds here, that number is 17%. So while they own 8.5% of the overall market, because promoters own about 50% of the Indian market in general, so of the free float, mutual funds own about 17%. So 17.5%. About 17.6. Yeah. And this again is the highest ever. So not only are mutual funds putting in more money, they are also putting more money at an increasing pace,
Right.
which is leading to a higher ownership.
So thanks. This answers the second question on domestic institutional participation. Moving on to third and the obvious one, how has the retail participation been over the last few years? And if you can share some color or throw some trends around retail participation as well.
Yes, of course, Abhishek. In fact, in the aftermath of the pandemic or during the pandemic, even the retail story has been the standout story of the Indian markets, possibly on a global basis. While we have seen retail interest rise in every market in the world, you have the Robin Hoods, you have the GameStops of the world in the US markets as well. But the Indian story stands out on its own. So India has 140 crore people, right? And very few of them have been investing in the markets earlier. Right. So if you look at pre-pandemic numbers, the total number of Indian investors was less than 3 crores. Yeah. However, in the last 3 years, this number has moved up significantly. Right. Today we have over 8.25 crore unique investors in the Indian markets, and these represent, by estimates, about 17% of all the households in the economy. Yeah. And retail investors today own about 9% of the Indian markets, 9.5% of the Indian markets. Now, I have to say this because I just mentioned earlier that mutual funds own about 8.5% of the market. Indians directly own about 9.5% of the Indian markets. Yeah. So that's the retail story. And I just said 8.2 crores people, right? Yeah. So the last 1 crore came in less than 6-7 months. Yeah. That's the kind of rise we are seeing in the retail story. And if you could again show this to you from a slide. So this is the retail story. I mean, look at this 20-year chart, and you will notice, in great contrast to what you saw for FIIs, who were buyers for most of the years, retail investors have not been positive for many years. Right. So
until 2019.
Exactly. And that's when retail investment picked up in a meaningful manner. So the pandemic, became, one trigger point in terms of, retail investors coming to the markets. There is no causality implied here, yeah. But you see these numbers, they are highly correlated. So 2020 was the first time when retail investors put in money. They put in about 40,000 crores that year versus a negative number for the last, you can imagine, about 8-9 years they have been putting only sellers in the Indian markets. In fact, 11 years. Yes. 11 years. And they did not look back. So if you look at 2021, this 40,000 plus number rose, it tripled to 1.4 lakh crores. And the next year also, it was around 87,000 crores. So retail investors in the last 2 years, 3 years or so have put in a significant amount of capital. Not only have they increased in terms of numbers in the Indian markets, because there are 82 million, 8.2 crore unique individuals, but they have put in a significant amount of capital. And today, the share of retail investment is higher than the share of mutual funds. I wish we could show you an ownership chart here as well. So yes, if you look at retail investments, this is the same chart but in a quarterly basis. Uh-huh. And just like we showed you for domestic institutional investors and foreign institutional investors, you notice that thanks to the incremental capital that has been put up by retail investors, their ownership is also rising. And as a proportion of free float, that 9.4, 9.5% that I told you is about 20%. 20%. So 1/5 of the Indian market's free float rather, is owned by retail investors directly, or individual investors. Right. Strictly speaking, individual investors directly in the markets today.
Got it. This is quite insightful. Moving on to the next question, so this is largely on the Indian equities, as to how the Indian equities have performed vis-a-vis the global markets. If there's any chart or if there's any color around that.
I think we can show you. If we can show this to you from a slide perspective. I mentioned earlier that the Indian markets are a reflection. Yeah, again, this was one slide which basically showed you how retail investments have increased in terms of not just flows but also in terms of activity. So what we have here,
it's important to note, as in on the retail investors now, NSE has a coverage of around 99.85% of the pin codes across the country.
Yes,
There's barely like 33, right? Yeah, 33 pin
just
codes which are
33
left
pin codes.
out of 19,000 pin codes. So that's an important point to be noted, and hopefully with the support of all the members, I think we should be able to reach 100%.
I hope so too. I hope so too. I mean, this is reach unlike many others in the Indian market. So equity markets today reach all but 15 basis points of the Indian
Absolutely.
mainland. So another important point that I wanted to make, we have been discussing retail ownership, which is about a fifth of the free float today and a tenth of the overall market. I also mentioned that retail flows have increased meaningfully in the last 3 years. But what we have here for you is activity. So the number of people that participated in the market. See, retail investments do not necessarily mean high activity. People can invest. So buying a retail share or trading in the cash markets is like buying a house. You buy it once. You don't need to buy it again and again. So what we saw was that pre-pandemic, it used to be about 20 lakh investors on a monthly basis. But that number rose to 1 crore around the pandemic. Eased up a little bit, but has come back to that number at this point. So this kind of gives you an idea about how much retail investments have increased now. Commensurately, even derivatives numbers have gone up, as you can see. About 38 lakh investors trade on a monthly basis
on derivatives. Yeah, if you can just move to the next slide.
Yeah, I wanted to show you about the market performance.
Market
So
performance.
if you could go to the market performance slides. Yeah, this we have spoken. Yes. So Abhishek, what I wanted to show you here was how Indian markets have performed vis-a-vis the rest of the world. So we have for you our Nifty, our benchmark index, and the broader market, which is the Nifty 500 universe of companies. And we have with you the MSCI World, S&P 500, and so many other indices, Nikkei 225, emerging markets. And what you see here is that Indian markets have done rather well this year. So the 10-year CAGR of Indian benchmark Nifty is nearly 12%. I mean, and that compares very favorably with any of the either developed markets or emerging markets, as you can see in the last column. If you look at, if you're a late entrant in the market, if you're one of those new retail investors, and you look at a 3-year CAGR, that number stands out even more. So, but as we say, equity is always for the long term. So even the long-term figures are about 12%. So right now, Indian equities have been tracking global cues. But if you look at a long-term figure, this is the numbers are there for you to see.
So thanks, very, very well covered, I would say. The next question if we switch on to equities, then obviously it moves on to the debt. So what impact do you see on account of the tightening of the financial conditions globally on the Indian debt market?
I can show that with you to you again from a slide. So,
absolutely.
While we get there, one of the points I wanted to make was that while global, if you can go to that slide, the debt slide, please. Yeah, again, if I can we go back? So Abhishek, I also wanted to point one important aspect to you here
on the equities.
Yes, please. On the equity side, I did mention earlier that Indian markets have had a 12% 10-year CAGR. It's the long. What we have here for you is a comparison of our Indian markets versus global asset classes. So, for instance, in 2013 or 2014, for instance, you had Shanghai going up 52%, Nifty 500 going up 39% or so forth. What is interesting in this chart is the second last column. So that year, we have discussed earlier how FIIs were the big sellers in FY 22. In that year, FIIs sold the highest that they had, ever $20 billion of sell in India. That was due to central banks raising interest rates. And when central banks raise interest rates, it is always negative for markets. And as you can see in the year 2022, beginning from the bottom, Bitcoin fell 64%, Nasdaq was down 32%, emerging markets were down as a class about 20%. So nearly bear market in most of the major markets in the world. But if you see Nifty 50 was up 5.7%.
Yeah.
So that is an outcome of what we have been discussing so far.
Right.
So Indian retail investors have been, on the DII side, but more so on direct investing. They have been saying, yes, and their entry into the markets, made sure that Nifty was up when every market in the world, major market in the world, was down. So
Significantly down. Yeah.
Significantly down. See, look at MSCI emerging markets.
Right.
It's down 20%.
20%.
And India is a part of that market. And yet it was up about 5.7%.
Right.
So this is the story that's
Awesome,
sort of coming out. Yeah, if you could go to the debt slide now, I can answer this question.
Yeah.
So what has happened is, thanks to the enormous amount of monetary easing that was done in the pandemic, significant amount, and before that also for many years, we had very low, interest rates across the world. Countries were trying to get to 2% inflation, but in the aftermath, because inflation rose up significantly, you had a rate hike initiation, as you can see here, and interest rates have gone up significantly higher across the world. So we are in a very high interest rate environment today, which is also one reason where most other economies in the world are slowing down. And India, as I said earlier in the talk, India stands out. India is the fastest growing economy in the world at this point. Yeah. And this, frankly, also is true not for the sovereign paper alone, but also for corporate bond yields. And this is again where you see, interest rate yields have slowly moved up. So in India, the movement of the policy repo, the overnight repo, has gone from 4% to 6.5%. So essentially, that's what you're seeing here.
So thanks, Satsakar. I think since you touched upon GDP, I think the next question, obviously, what we have here is, what are the key drivers to the India's growth, and do you foresee any downside to this story?
Okay. If I can again put this to you in a quadrant.
Yeah. Any risks that you foresee or any downside that you foresee to this Indian GDP story?
Yes. So the way we could, classify this or categorize this the following. Indian economy grew by about 7.8% in the first quarter of this fiscal FY24. And as I said, this is the fastest growing economy at this point. The policy repo is up about 2.5%, and interest, inflation has been easing off, but it's not enough. So, RBI has basically said at the end of the year, we'll end at probably 5.4% interest, inflation. In the first quarter, we'll go to probably 5.2% inflation. So, 5.4% in FY24. That's the point. What is good is that core inflation has been easy. 4.3% is a good number. But to your point, challenges today are a global slowdown. So everywhere, because you had central banks raising rates in 2022, the rest of the world is slowing down.
Right.
And one part of our growth story, fully 20% plus, is the trade story. So India's merchandise trade, or India's exports, or India's imports. The way I look at it is, India's exports are global demand for Indian products. Global imports for Indian products, and India's imports are Indian demand for global products. So if you have a slowdown in the global economy, that's going to be an overhang for Indian exports as well.
Right.
So this is a challenge from a global slowdown perspective. While the Indian economy is, strongly domestic, a large part of our story is consumption, over 60% of it, or nearly 60% of it. But as we are growing bigger, enmeshing ourselves, integrating ourselves a lot more with the global economy, and that has an overhang as well. And this, high interest rate environment that I had mentioned earlier, if it sustains, it naturally means that not only are sovereign paper high, you have corporate bond yields that are high, which translates into higher WACC for companies, and which translates into lower growth. if you have high cost of capital, that's
Absolutely.
going to absolutely, work on this, on growth, future growth. And the other point is when you have high interest rate environment, indebtedness, see in India, indebtedness is not high, first of all.
Yeah.
And even if it is at a sovereign level, say 80% plus of GDP, it is over 95% domestic.
Right.
So, but this is not the case in many countries of the world.
Yeah,
So
they absolutely have much higher, right? 120, 130%.
130%, and in many cases they have it in dollars. So
Right.
they face not only interest rate risk, they also feel exchange rate. They feel exchange rate risk,
Right.
and that could lead to financial market volatility. So that brings me to my other challenges at this point. However, for India, that said, your strong consumption demand, there's a very strong capex push by the government.
Right.
See, today of the Indian budget, so we have 300 lakh crores of GDP, 45 lakh crores of Indian budget, of which about 20% is capex. So this number, even 10 years back was just about 8% or so.
8%.
Now it is 22%. So favorable policies have really helped, and there is a conducive domestic environment for private capex. What do I mean by that? We had a twin balance sheet crisis for several years. Today, balance sheets are in much better shape. You have bank NPAs, which is less than 3%, gross NPA numbers. And overall,
Significant deleveraging by corporates as well.
absolutely. So, overall leverage used to be around 1.4x. Today, that number is about 0.7, 0.6. So the corporate balance sheets are in a much better shape. I think that is something that's going for India.
Yeah. Well, thanks. I think absolutely. And then bang on. The last question, obviously, since you mentioned about the corporates, the last question of the session is, I mean, recently, as you know, the second quarter of corporates earning has concluded. So, the question here is they wanted to know as to which are the sectors which are doing well or any key trends. Is there anything which you wish to highlight to, the investors?
Yeah, sure, Abhishek. So we saw overall profit growth for the Nifty 500 at upwards of 40% on a YOY basis. That number is fairly strong. Sales was muted. So a lot of the earnings recovery or earnings jump up came from lower raw material costs. If we could show this to you from a slide. So notice here that if you look at the Nifty 500 and if you look at the last three columns here, overall sales growth was just about 5%.
Uh-huh.
But EBITDA growth was 42%, PAT growth was 45%. So this
Right.
is what is basically seen. So because raw materials came down significantly, the growth number was fairly strong. And if you exclude energy here, Nifty 500, your net sales also went up to double digits. In fact, if you exclude commodities here, the net sales go up 13%. So
Right.
I think corporate universe is a reflection of what's happening in the overall economy. Consumption is doing rather well, and Indian corporates are enjoying the fruit of lower raw material costs. So you've had, and that's what is showing up in strong EBITDA growth here. From a PAT growth perspective, if you notice, energy, consumer staples, healthcare, these have been sectors that have stood out, utilities as well, and that is where you have had a significant amount of profit growth as well. Whereas there are other sectors, as you can see here, that have not done so well in terms of PAT growth. So materials, IT, these have been have seen lower profit growth than previous year. And if you could show you one more slide, in terms of who's essentially contributing to the profits. So in India, financials is the largest sector.
Right.
And if you look at the top companies, they contribute nearly a third of the entire profits of the top 200 companies. So that number has not changed over the last several years. And this is if you look at consensus numbers, that number is not likely to change either. So about 30% or 31% of all profits will come from financials, followed by energy, materials, information technology, and so forth. And also something that stands out is consumer discretionary is expected to do better because of the consumption theme that's sort of going on. And these are consensus numbers; these are not our numbers.
Right.
And overall, I mean, the idea was to provide a sense of who essentially contributes to the overall profits in the economy.
Thanks, Tirthankar. I think that's it for the day. a big thank you for again joining in. I would like to again give a vote of thanks to all the members, investors, and various other participants who have joined today's session. As I mentioned, and I keep on mentioning in every open house session, we look forward to you for any new ideas, any new suggestions, any new topics in which we can bring out the next session. So feel free to write to me or any of the relationship manager who you are associated with, and we'll be more than happy to take it up as a part of the next session. So thanks and goodbye.
Thank you, Abhishek. Thank you. It's been a pleasure.